Hi, my name is Stuart Weems and welcome to the Investopoly podcast. My goal is to share easy to understand holistic insights to help you master the game of building wealth. So let's get into the Q&A session today. And the first question is from Jason, pretty interesting one. Jason writes, my wife and I are 50 and 47 years old, own our home outright and have slightly higher than standard incomes. We have multiple property investments both in and outside our self-managed super fund with very little debt. Our strategy is to buy something, pay it off, and then once paid off, move on to the next one. We now have a total of 7 properties that are all paid off and working on paying off the number 8. These are spread across 3 states, which we've cherry-picked properties, and unknown at the time has also helped us manage land tax. We have an investment trust which holds 4 commercial properties debt-free, producing income, plus a parcel of ETFs and hand-picked blue-chip shares, which have been selected depending on which month they pay dividends. So now the trust receives rental income and dividend income every month, which continues to be reinvested into more shares. The trust is something we started for intergenerational wealth for our 2 sons, aged 16 and 11, which is our most important financial goal. My question relates to a case study of a wealthy European family in the book Family Fortunes, whereby the children contribute all their income to the trust as they start work, and then the trust supplies them with a house, living expenses, etc., to see the family fortune increase exponentially. We are, as a family, very keen to follow this type of model. My goal is to continually compound and accrue assets, never sell, and have my boys continue this in perpetuity. Although only young, they are advanced with their understanding and have intentionally always been part of our investment process. We as a family are all interested in looking further at this type of intergenerational structure, but haven't been able to find anything to model it in Australia. Are you able to give me any families that we can use an example, or books/guidance, etc.? Any advice would be appreciated. Jason, it's a really interesting question, something I've never really contemplated or come across. The problem is, if you look at statistically family businesses or family structures, they don't have a great success rate. I guess whilst you might be of the mind to do this today and you might feel like your sons are of that mind to do that, they might marry people that might frustrate that process, or they might change their mind as they grow up and want to do different things or have different ideas. And money and family tend not to mix, and we only need to look to wills and estates for an example of that, where you can have a perfectly well-functioning family, then the matriarch or patriarch passes away within that family and everything falls apart. And then relationships just come down to fighting over money, and these things are very common. So, it's risky. I think if you look at the data, and again, I talk about evidence-based investing or evidence-based approaches, what's the likelihood of this working and being successful for many, many generations? Who knows? I think the sort of structure you're looking... No, my answer is no, I don't know of any examples or books that'll give you that guidance. In fact, there's a lot of books of families falling apart and succession's not really working. There's probably not a lot of examples or books where they've worked perfectly well. And I think that's kind of the point I'm getting at. I think in this situation, you would think about a trust, and you would probably want to customize the trust deed of that trust. So, for example, you could say that you're going to have a family. I know you've got an existing family trust, but it's probably just a standard deed and so forth. What you could do is have a deed that provides for various requirements. So you could have what's called a bloodline discretionary trust, which means that the only beneficiaries can be bloodline beneficiaries, and that could protect the assets in case of a marital breakdown and these sorts of things. You could have a trust that restricts the distribution of capital, so the only amount of money that a beneficiary can take is the income in a particular year, or income realised capital gains. And you might say that the capital is restricted purely only for life-saving medical interventions, for example. Or you could, in the trust deed, restrict the amount of income that you could take from the trust. So if you want these assets to compound in perpetuity, you could say the trust cannot distribute any more than 50% of the income earned during a particular period, and therefore the trust retains some income and continues to compound. That would be the way to start to think about, creating intergenerational wealth. And that's what most families do. They have these customized trust deeds that protect the original capital or protect the control of the trust and those sorts of things. Having said all that, whether your idea is a realistic one, and no judgment on your family, of course, I don't know you, Jason, but I'm just not sure. If you look to the evidence, I'm not sure it's really going to work in the way that you might hope. There are firms out there that specialize in family businesses, family offices, and these sorts of things. You probably want to find one of them or hunt one of them down. No firm or business comes to my mind, but that's the way I'd sort of think about it. I don't have a lot of experience here with those sorts of things, so I haven't been able to give you some specific direction or advice there, Jason, but thanks for your question. It's a really interesting one. My personal view is that, you try and do the best that you can do with your wealth and you pass some on, maybe even donate some to charity, and then even if it's successful, at some point, a generation ends up ruining it, whether it's your children or your grandchildren or your great-grandchildren. There's a lot of stories out there. One generation will end up wasting the money or ruining it, and that's just the way it goes. Can't really rule from the grave. But anyway, great question, Jason, and thanks so much. Next question is from Tracy, and Tracy writes, I enjoy listening to the podcast and appreciate all the content you put together. Thanks so much, Tracy. You're very, very welcome. Tracy goes, I've got a question if you can help me. I have an investment property one, which is valued at $1.5 million with a mortgage of just under $500,000. I would like to refinance and get access to $200,000 of cash in a separate loan, which I'll use to buy another investment property as a deposit. If in the future I move into the investment property, the original one, property one, will the loan for the main residence of loan one or the total loan of one and two be non-tax deductible? So because she's now living in the property. So Tracy, it all comes back to the purpose of the original loan. So the security doesn't have an impact. Often, not always, but often the applicants, so the names on the loan, don't matter as well. It really comes down to when that loan was set up, what was that money originally used for? And that will determine whether it's tax deductible. So the original loan, the $500,000 loan secured by property one, or used, I should say, in respect or related to property one, if you moved into that property, that loan would become non-tax deductible because obviously it relates to the asset that you're now living in. The $200,000 equity that you extracted from that property, which you used to buy property two, an investment property, will continue to be tax deductible because obviously the purpose relates to that investment property, and that investment property, number two, is still earning an income. So it really comes down to purpose. There are situations where who makes the repayments on the loan can be important. So that is whose account it comes out of. And quite often you might have, for example, a loan in one spouse's name, but the repayments come from a joint account in both spouses' names. And in that situation, the ATO has tried to argue in the past that actually the repayments were paid 50-50 by both spouses, but only one spouse owns the property, so they should only be entitled to 50% of the tax deduction. But I've never seen a situation where the applicants on the loan have a big impact, and certainly the security of a loan has zero impact as well. But great question, Tracy, and it's really important. I've spoken about previously in the podcast, making sure interest is your biggest tax deduction for property investors. Make sure that your loan is structured correctly so you never put that tax deduction at risk. Consisting of $250,000 in Vanguard and $300,000 in individual shares against a margin loan of $200,000. So the net equity in that portfolio is $350,000, obviously. I also have $60,000 invested in a raise account when I started to contribute to this last year for diversification. I am investing $3,000 a week, $2,000 into Vanguard and $1,000 into the raise account. What else is there to do in terms of investment? Interested to hear your thoughts and suggestions. Well, firstly, Jonathan, you're doing really, really well. I mean, you're paying down debt. You've got, almost four properties with very little debt. Well, not almost. You've got four properties with very little debt. Very healthy super balance, invested in shares. I'm not sure about the 70% Australian, 30% international allocation. Let's not forget, people, that Australia only makes up 2% of developed markets in terms of listed markets. So you're missing out on a lot of industries and exposure by investing heavily in Australia. Yes, it's got a high dividend yield, which is great. You bank the income. So I'm not suggesting have no Australian, but actually, if you look at the relative performance of Australia versus international over the last 10 or 15 years, it's been pretty poor. Like, Australia's been pretty poor. Now, that'll eventually turn around, and I recorded an episode last year in that regard. But I think 70% Aussie exposure inside super is a little too much. I would actually say you were better off just going a premixed option. I think they've got an index premixed option as well. Host Plus has. So leave the asset allocation to the experts. They can work out how much to put in emerging markets, how much to put in small companies, how much to put in international, how much to put in Aussie, and so forth. So that's one thing I would change is, don't manage that asset allocation yourself, leave it to your fund. You've got the share portfolio, but you're a high income earner. So that means that you just want to be careful, of the funds that you're investing in. You've just mentioned Vanguard, so I don't know which Vanguard fund you're investing in, but be careful about the components of return from that portfolio. So I'd be starting thinking about that. I'd also question whether you'd be better off, you're investing $3,000 a week. It's a significant amount of money. Maybe you'd be better off investing that in a company, because at least the company, the tax rate is capped at 30%. And I have recorded an episode on investing, creating an investment company. And the episode is called Would You Like a Third Super Fund? And the episode was published on the 23rd of August, 2023. We weren't recording the episode number, but it's actually episode 271. So you might want to go back and have a look at that episode. Of course, you'll find it on the website, or do a Google search. And that talks about the benefits of having an investment company. And that would help you minimize the amount of tax you pay on your investment earnings over the next 10 years. You said you're 50. Let's assume that you're going to work for another 10 years. I don't know. But also the benefit is that putting it in a company, whatever tax you pay over the next 10 years, you'll get a credit for. And when you're retired, you'll obviously have the property income, the rental income, but then also you will enjoy the benefit then of the imputation credits. So really, you're paying 30% tax now, but you might end up getting some of that tax, or you will end up getting some of that tax back later when you start paying yourself a regular dividend out of that investment company when you're retired. So when you're not earning any earned income, so PAYG or employment income. The other thing I'm thinking about is you've got $1 million in super, you're 50. Again, let's assume you work for another 10 years. What will your super balance be in 10 years' time? Well, there's plenty of, assuming you contribute $30,000 a year, well, there's plenty of calculators that will help you kind of work that out. I project that the transfer balance cap, if continued to be indexed as it is set out in the legislation, will be $2.5 million in 10 years' time, which means that you can have up to $2.5 million inside super, and it's not going to attract any income or capital gains tax on the investment earnings. So, Jonathan, I would start thinking about, in your situation, yes, you're accumulating assets outside of super, the ones that I just spoke about. Well, maybe you should put it in a company, but also how are you going to fully utilize the $2.5 million transfer balance cap? That's assuming it's be $2 million in 1 July, but let's assume it's going to be 2.5 by the time you get to retirement. So should you be making the $3,000 investment per week? Should you be making non-concessional contributions, for instance, and putting it inside super in personal names, or rather than an investment company that I just sort of spoke about? Or is it a case of the way you're going to do it is, are you going to sell an investment property and then make some contributions at that point? Remembering that you've got contribution caps that you can play around with. So you might not be able to, sell it one investment property. You might not get all the money inside. And also you might not want to sell the investment properties at some particular point. So what could you do differently? Yeah, I'd change the asset allocation inside super. I would have a careful think about where you're doing this share investing, whether that's in personal names company or super, or it could be a combination of all those different answers. Remembering that if you put it inside super, it's locked away until you're 60, so you won't be able to access it for another 10 years. And depending on your plans, that might not suit you. And then it's really about, how are you investing those monies? Well, you've said Vanguard, but, I see it now. You're putting 50% in Australia and 50% in international. So you're investing $2,000 a week, so $100,000 spread across those two funds. That's okay. That'll work. I think you probably do something different. Let's not forget that international Vanguard share fund, about 70% is invested on a market cap basis in the US. And we know that large cap stocks are dominating that index. And we also know, looking at future 10-year returns, the probability is they'll be below average, which means that that pure market cap Vanguard index share fund will probably underperform. And then Australia is 2% of the developed market. So whether there's a better approach, I guess, to investing, I would argue that if you're investing, well, you say you're investing in full $3,000 a week, that's $150,000 a year. I reckon that's worth getting some financial advice, someone to manage that portfolio for you. Because if you do that over the next 10 years, how you invest and the asset allocation you use and the combination of different, hopefully rules-based strategies you use could have a big impact. And you are, by taking that approach, putting yourself in risk of the Aussie market continuing to underperform, and secondly, a major correction in the US in terms of large cap dominance. And the statistics tell us, the evidence tells us that market won't perform as strongly as it has in the past. So that might not work well for you. So they're the things I'd be thinking about in your situation, Jonathan. Of course, none of this is advice, just information only, as my friend James Kirby over at The Australian continues to tell us. But they're just some things that I'd be thinking about. Okay, next question is from Brian. That's a pseudonym. He didn't want me to use his real name. So Brian writes, thanks for all your help on the podcast. My partner and I appreciate it. We're really struggling. Oh, you're welcome, Brian. We're really struggling to decide our next step and feel like we may have made a mistake overextending ourselves with our first investment property and feel stuck moving forward from it. I suspect a lot of people find themselves in a similar situation to Brian. Okay, so here's his numbers. We're both in our early 30s, collective equity position of about 250,000 invested in shares and crypto. The investment property they bought a year ago in Brighton, Brisbane for $800,000. The mortgage is $770,000, so about $130,000 of equity with a 4.3% gross rental yield. $250,000 cash sitting mostly in the offset against the Brisbane investment property. Some is allocated for another home and some is allocated for travelling and enjoyment. And they are currently rent investing in Melbourne, no principal place of residence. Their incomes, myself, Brian's income is 150, partner is 160, super is 150 collectively. Savings of about $3,500 go into the investment loan and offset account, but they could increase that to $5,500 if they stop investing in shares on a monthly basis. Borrowing capacity at the moment is $750,000 collectively. Now, their goal is to build financial independence, but also buy their own primary place of residence in Melbourne, but it's currently unaffordable in the suburbs they want to live, which would cost $1 to $1.5 million in around the Box Hill area, unless they compromised and bought a smaller villa unit for about $700,000 to $800,000. So their options are, as they see it, three options. Option one, expanding the investment property portfolio and continuing to rent invest. We have been renting for almost 10 years and are happy to do it for another 5. We could buy another investment property for $500,000 to $600,000 anywhere in Australia and build equity in the short term, 5 to 10 years, and then sell to buy our dream home in Box Hill. Option 2, buy the primary place of residence, a villa unit in desired area, spend about $700,000 to $800,000 and invest for the next 5 years and then upside if there's equity growth. Option C, keep saving cash and invest in shares and let the Brisbane investment property continue to build equity and use that equity to purchase a desired house in Melbourne in 5 years' time. Really appreciate your input. Brian, it's a great question. Really hard to answer kind of on the fly, without doing some numbers and, thinking very deeply about it. But I have actually thought about it. I reckon my gut feeling would be none of the options that you've suggested I mean, I think you're right. Your first observation, maybe we made a mistake overextending ourselves with our first investment property. I'm not sure I would say that, but maybe you made a mistake with respect to the order in which you made your investment decisions. That's probably how I would frame it. So if I had my time again, if you had have submitted this question a year ago before you bought Brisbane, what would have I said? Well, I would have said if you've got a $1.5 million borrowing capacity, which you kind of have in terms of total debt, and it certainly aligns to with what you're telling me, I would have told you go and buy that forever family home now, occupy it for 6 months, so it's your primary place of residence. Keep all the evidence that suggests that demonstrates or proves that, I should say, council rates notices, utility bills to demonstrate you're living in the property, electoral roll, nomination, license, all those sorts of things. Change it to that address. Then in 6 months' time, you'll change your mind and decide, you know what, we want to put a tenant in that property and continue to rent invest because we think we can get more income from that property than what we'll have to pay in rental income. And plus now we've got a dirty big mortgage. We'd like to make that more affordable by making sure that the interest is tax deductible. So you'd move out of that property, go and rent somewhere else, and that is your investment property, and you'll have 6 years before you need to pay any capital gains tax. And hopefully in 6 years' time, the debt relative to the property and relative to your other income is much more manageable than it is today. That's what I probably would have told you, no, almost certainly would have told you a year ago. So now the question is, just because you made this decision to buy this Brisbane property a year ago, should we let that hang over our head and influence what we do from here? And of course, the emotional decision is, yeah, that feels safer. But I think the logical decision is no, of course not. I mean, if you find yourself digging a hole, stop digging is the answer. So I think what I would do in your situation is my gut feeling is I don't think prices in Melbourne will move over the next year or so. Although I could be wrong, but that's my gut feeling. I think delaying buying in Melbourne for a year is probably not going to cost you too much. But delaying buying in Melbourne for 3 years, I think there's a much greater probability that you'll be worse off. So I'd keep the investment property, Brisbane investment property as much, maybe another 12 months. Hopefully you can get a bit more growth out of that market. I'm sure you probably will. I'd then sell it and then I'd go and buy your dream home in Box Hill. And then I would do exactly what I suggested, that is go and occupy it for 6 months, make sure it is your primary residence, and then go back to rent investing for, as long as you want or as long as you're comfortable do so until, you've got more cash flow to be able to repay debt, offset debt, and get in a position where it starts to become affordable to live in. Of course, if you're going to take that approach, then I'd stop investing in the share market and put all my $5,500 a month into the offset account to build that cash. You don't want to take that risk. And similarly, if you've got any shares or crypto that you think, is fully valued or overvalued now, I would take profit and put that in the offset account as well. What we're trying to do obviously here is minimize the borrowings on the Melbourne investment property. Now you might look at that and say, Stuart, it's a shame to go and buy a house and then sell it within 2 years. And I totally agree. But I think the thing here is the quicker you can get into this much better quality asset. So if we're talking about villa unit versus a standalone home, the quicker you can do that, the better off I think you'll be in the longer run in terms of positioning yourself for future growth. So I think that's what I would do in your situation, Brian. And sorry that it wasn't option 1, 2, or 3, as you indicated there. And it's not the easiest option to make a decision on, too, by the way. So I get that. But that's unfortunately what I think. Okay, next question is from BP. And BP writes, Happy New Year. So I must be at least into the questions received from the beginning of this year, although it says I've got 32 pages, well, actually 28 pages of questions left, which is great, by the way. So keep the questions coming because I love the content and I do enjoy answering them. And I'm glad that people enjoy listening to them. Anyway, BP writes, thanks so much for selflessly contributing in upskilling the personal finance knowledge for the community through the podcast and blogs. One of my favorite podcasts to listen to on my travels. You also have a great voice, which is soothing to listen to, which is a bonus. Thanks, BP. I actually never thought that, but there you go. And I appreciate the lovely feedback. Could you please guide me with my current dilemma for the next step of my financial journey? Okay, so here's a bit of background. We're a couple living in Sydney 35 years old, both with 2-year-old twins with a family income of $370,000, excluding super and bonus. 2-year-old twins. I've been there, BP, so good on you and good luck with it all. Our current mortgage is $1 million, and we also took $250,000 of equity from the property to invest in ETFs. IVV current value is 300,000. So for people listening, IVV is the S&P 500 market cap index fund by iShares. Their property is currently valued around $1.85 to $1.9 million. After mortgage, daycare is a major expense, costing us around $5,100 a month. Daycare is insane. And I heard an idea, one of the team here at Pro Solution made a great comment that daycare expenses should be tax deductible. That would be the easiest way, I think, for the government to defray some of that cost. Currently, we're able to save $5,000 to $6,000 a month, and they've got $150,000 in the offset. We do maximise our super each year, and the balance is around $200,000 each. In terms of future goals, the goal is to have 2 big properties, 700 square metres of land worth around $2 million each in Sydney, and maximise super every year, and hopefully an ETF portfolio fully negatively geared outside super. Our current property is custom built, and a great portion of the value is in the building, 400 square metres of building. We'd like to sell this property in the near future and buy in a better suburb, although the total property cost would be similar at around $2 million. We'd want the new property to have a larger component of land value than building value. Our question for your help: we'd like to buy a property in a better suburb with good schools before the kids go to school in 2028. Our broker said with current interest rates, we've got a borrowing capacity of $1.3 to $1.4 million left. We're exploring the following options and would love your thoughts on these, please. Okay, and the options that BP has laid out, with noting a few pros and cons. The first option is buy a property now in Sydney for around 1.2 to 1.4. Option 2 is keep saving and buy a $2 million property in the desired location at the end of 26, beginning of 27. Option 3 is buy interstate in Brisbane or Melbourne now for $1 million to 1.2. And I imagine the idea behind that is to generate more equity and potentially be able to use that equity or sell that property down the track to upgrade into their better location. Okay, BP, the first observational comment that I would have is that you said you've got your current home is worth about 1.8, 1.9, somewhere in that order. You got $1 million of lending against that property, but you acknowledge that it's more building value than land value. It's a lot of building value versus land value. And you would like to have 2 big properties, that is 2 land value heavy properties in Sydney, which I think is not a bad strategy or idea or focus. So the question would be, well, why wouldn't you go and sell your current home for 1.8 to 1.9 and then borrow a little bit extra and buy that land value heavy asset? And maybe it's because it's not really where you want to live in terms of location. But that would be my first point of call is, before adding additional assets to a portfolio or strategy, think about or come up with a plan for the existing assets, which could be, a shorter term plan. It could be I'll keep it for another 3 or 4 years and sell it. Or it could be sell it today and then just replace that asset. But that's the first thing that I'd really think about. If we think about Brian's example that I just answered, where they bought the property and now they potentially, well, I've said, at least off the cuff, that I'd probably go and sell that existing property. You certainly don't want to repeat that same mistake. So I don't really like buying in Sydney for 1.2 to 1.4. I think you're going to compromise too much. And even if you buy a heavy land value asset, you're going to compromise, I guess, in terms of locality. I think option 2 of buying the $2 million property in 26, 27, I think that sounds pretty good to me. And buying interstate, again, you're just further away from your goal, not closer to it. In fact, you're further away from your goal without actually having to sell or needing to sell a property, which we don't really want to do, of course. So I'm not really attracted to that option either. But I think I'd come back to my first observation is, why don't you sell the existing asset if you don't think it's the right type of asset that aligns with your goals and where you want to be and what you want to own? Why don't you move that one on now? If that wasn't doable, then I would hang out and try and do that upgrade or buy that $2 million asset in 26 or 27. Of course, interest rates will come down. That'll improve borrowing capacity. Maybe APRA might end up relaxing the 3% benchmark interest rate as well. That could improve borrowing capacity. You mentioned your family income and you said excluding bonus and super. Well, if you got some consistency around bonuses, the banks will include it or count or rely on some of that bonus income in terms of borrowing capacity. So that could help as well. And sometimes it's just about, I don't know, it's funny, I tend to say, look, long-term decisions, focus on long-term, come up with a long-term plan, all those sorts of things. But sometimes with property-based decisions, the best thing you can do is just make sort of the best decision you can today. With it, so sometimes it means, look, you don't know how you're going to get there, but you're not there yet. Sometimes the best thing to do is wait. I know that sounds a bit wishy-washy, but certainly I've done that in my past. Is that I know I've got an eye on the goal, right? I know where I want to get. So if I'm BP, I know I want to be able to get myself into a position to afford a $2 million asset. Don't compromise on that goal, though. Don't think that there's another way to do it. Then it feels too contrived and you're trying to fit a square peg in a round hole. Instead, focus on that goal. And if it takes you 2 or 3 years to get there, that's a better approach because you're not going to compromise. And you might not be really clear on how you're going to get there. Of course, as I just alluded to, a few things could change to extend your borrowing capacity so that becomes doable. So you might not perfectly know how you're going to get there, but I think just focusing on that goal, getting the right advice, getting a great mortgage broker, these sorts of things will help, push you in the right direction and you'll eventually find a way to do it. Again, that's very wishy-washy and not necessarily perfectly implementable advice, but that's really the approach that I've found personally that works well, that's worked well for me. And, there's just not any reason to compromise, I don't think. And the previous sort of question from Brian was a perfect example of why just compromising and trying to do something else just for the sake of doing something often isn't the best approach. Okay, I'm going to leave it there for today. Thanks very much for listening. Just a few things before we wrap up, if I may. Of course, you can send me questions at questions@investopoly.com.au. But for a quicker response, feel free to add a comment on the episode's video over on YouTube. We have an Investopoly YouTube channel and the link is in the show notes. I'm incredibly grateful for the 4.9 star rating on Apple with over 400 reviews. Thank you so much. If you can leave a review or rating, I'd love it because I'd love to get over 1,000 reviews. That's kind of my target. Keep checking the show notes for free downloads and I include book discounts there as well. And of course, if you're interested in working with my team and I've included a web link where you can find out a little bit more about what we do and get in touch with us. And of course, until next time, bye for now.